Folks, is this the beginning of the end, or is it moon time? That's what we're going to talk about in this video. We've got quite a few charts, and we've got an interview from Credit Suisse and an interview with Bloomberg that we're going to do some reacting to, because it's actually quite optimistic. But the question is, am I getting optimistic about this? Is this the moment that we're supposed to get really excited, or is this more cause for concern? Let's go ahead and get started with exactly that thesis right here, folks. And yes, the price goes up tonight. We did extend the coupon code until Thursday at 8 p.m. California time, so you've got until tonight. And then the price is going up for the programs on Building Your Wealth again. Lifetime access and course member live streams with me every day the market's open. Here we go.
Give me your year-end forecast. I know it's constructive, and walk me through why you think it's achievable, given all the risks on the table right now.
Yeah, I mean, listen, I think that we're going to have a double-digit return between now and the end of the year. And I'll tell you what I think drives it. If you look at if what we've seen so far this year, profits are up 7.5% year to date, and they'll probably be up another 5 to 6% between now and the end of the year. So we don't have a profit problem as much as people say. What we have is the value.
Hold on a sec. Before we get to what we have, let's think about this for a moment. Let's analyze this with a few charts and updated pieces of info that we've got. So really what he's saying here is that, hey, look, we've had such a painful beginning of the half, but that doesn't correspond to the fact that we actually had earnings increase in the first half, and we're still expecting earnings to increase in the second half. So I did a little bit of digging, and I found this, which was interesting. The S&P lost 21% in the first half of 1970 during a period of high inflation. Now, I think this is a very important and understated element right here, because we keep hearing talk about this soft landing, right? Jerome Powell says, well, we've been able to achieve a soft landing 3 times before. Sure, but look at, well, not this chart. Look at this chart right here. These right here are the prior periods in which we had a soft landing. The blue line represents inflation minus the target, which is 2%. So basically inflation at the time was actually 2% higher, but they're just trying to show on the chart how far away we are from the target. So that way, when you're right here, you're about 5% away from the target. Where we are right now is also about 5 to 5.5% away from the target, right? Well, the problem with this idea of, oh, we're going to have this soft landing is that, wait a minute, the soft landings Jerome Powell talks about here, here, and here all occurred during times where inflation was at or below target. Now, the Federal Reserve didn't actually start creating a precedent of bailing out the market until right here. So sure, we've had one post-Fed bail everything out, print money to save the day kind of bailout. We've only had one situation where we've had a soft landing after that. Now, when we look back to 1970, though, again, a period of high inflation, which I think it's so important to compare to. Take a look at this. First half of the year, what happened? S&P 500 loses 21% the first half of just that 1 year. The next 6 months, the S&P literally roars 27%, which is obviously similar to what we had in 2020, where we dropped 4% in the first half and went up 21% in the second half. Well, not similar in the second half, not similar in the first. But then again, 2020 was the total Federal Reserve bailout. 1970 is a little different because we've got massive inflation, we leave the gold standard, we've got the failure of price curbs, which the interesting thing is the failure of price curbs and the lifting of price caps going into the early 70s and the late 60s actually led to more earnings and more revenues at companies because they were finally able to raise prices appropriately. So that way prices would be at a level where prices would end up matching demand. But, and supply and demand would line up, right? We'd have an equilibrium. Of course, this ended up leading to insane runaway inflation and insane expectations of inflation continuing forever by the end of the 1970s, which led to us getting Paul Volckered in the 1980s, which is not what we want to see happen right now. But it's really interesting to think that, okay, so here we go. We've got an individual from Credit Suisse saying, hey, well, earnings are still doing great here. We could have a boomer of a rally and potentially rally as much as 26% by the end of the year. Okay, that's interesting. Let's see what else he has to say. Let's pop back on over here. And eventually I will fix the HDMI, so don't mind the flicker.
Valuations, a PE multiple is down over 30%, I think 31% on the market. And that's an enormous adjustment, which makes stocks much, much cheaper.
Okay, some on-the-fly fact-checking as we go along. He's not wrong here. Multiples measured by the red little mountains here. My son Jack calls them the red mountains, okay? Multiples have gone down substantially. They've collapsed. We haven't actually really seen revenues collapse yet, or therefore earnings per share expectations really collapse yet. Although earnings per share expectations have started to inflect down after, well, what happened? Target and Walmart reported. See, the white line represents the blended forward 12-month EPS estimates. But the average analyst price target has actually started getting moved down. So we still see high EPS targets. But on the right side here, this blue line, we see, analysts are starting to lower their price targets. Now, the weird thing, though, about analysts, and I'll tell you, I hate this, is analysts just seem to move their prices based on what the stock market is doing. So if a stock soars, oh, wow, we're increasing our price target. If the price falls, oh, we're lowering our price target. So I pay a little bit more attention to that white line, that EPS line. We haven't really seen a compression there yet on EPS, which actually reiterates what he says about, hey, if earnings hold up, we might have a rally towards the end of the year. Now, I want to tell you what I'm doing in reaction to this, and there are a few more charts that we got to look at that are extremely important. But first, we got to get in a message from our sponsor. Now we got to talk about our sponsor. And folks, it's summer. The sun is out again and people are finally going outside again. But before you start working on that summer bod of yours, you might want to take a step back and make sure your family is protected first. And thankfully, today's sponsor, Fabric, makes applying for life insurance coverage easier than ever before. Fabric was built for parents to help manage their family's financial future stress-free. They make getting a quality term life insurance policy quick, easy, and super affordable. Fabric offers policies issued through and fully backed by Vantis Life, who have been offering high-quality insurance policies for over 150 years. Fabric has moved life insurance completely online, so getting a policy that's right for your family is no longer complicated and time-consuming. It can be done in as little as 10 minutes. Fabric has significant savings over other providers, and you can get $1 million life insurance policy for less than $1 per day. Fabric also has over 1,600 five-star reviews on Trustpilot.com, so you can feel confident that you are getting a high-quality policy. Fabric has a 30-day money-back guarantee, and you can cancel at any time. So protect your family's financial future with Fabric. Apply today in as little as just 10 minutes at meetfabric.com/Kevin. meetfabric.com/Kevin. MEET fabric.com/Kevin. Welcome back. Here we go to the part two.
I think that the earnings continue to move forward, and we think that you get a bounce in valuation, probably a couple of multiple points between now and the end of the year. Stocks will still end the year cheaper than they started, and they'll be up double digits between now and December.
John, can I ask you this? Do you think the Fed will be happy?
I just want to clarify that. He said, hey, up double digits by the end of the year, still negative. But double digits by the end of the year, that's pretty bullish.
See that?
Yeah, I talk to people at the Fed. I don't think that they are focused on what the stock market is doing. What do they care about? They care about inflation and jobs. I think, so I really think that they're focused on the mission. And I think Powell may be behind the curve, but he's doing a pretty good job of being clear what his focus is right now. Inflation is too high. They have to address that. And that's where they're going to spend
John,
time.
the reason I asked that,
let's just quickly reflect on that. Do we actually think the Fed doesn't care about the stock market? No, of course the Fed does care about the stock market. We know that. Here's a chart of U.S. CEO confidence. We're at some of the lowest levels that we've seen since not only the pandemic, but obviously going back to the Great Recession. So, this is a problem. A recession, obviously, right here, the Great Recession. And we're trending towards low levels, right? So when you get this CEO confidence decline, at the same time as you're getting expectations for price targets going down, and we're seeing credit card spend decline, it does make you wonder, maybe the Fed does actually care about the stock market because all of this has aligned with the stock market going down, creating a wealth effect. When people feel like they have less money, what happens? They spend less. Now, I read this crazy report the other day about how Bitcoin, yeah, folks, Bitcoin disproportionately affects younger men who are disproportionately likely to spend money on stuff, whether that's for their friends, their family, their girlfriends, watches, cars, boats, you name it. They're more likely to take the money and spend it. And so if you crush crypto, you crush the wealth effect amongst a cohort that's very likely to spend it. Maybe crypto could be the reason we actually start seeing disinflation because valuations have come down so much. An interesting little mind trip there. But we've also, and this is an important one to break down right here, when we look at this particular chart right here, what do we get? We get spending growth of consumers in both the high and low end products, according to Barclays, drifting lower, right? We see these charts going down, both the higher end and the lower end. But something that's really important about this chart, and this is where it's kind of like, we get kind of data on both sides, but do we? I don't know. This says growth in spend, right? It doesn't say spending, it says growth in spending. And as long as we remain above this line right here, the green bottom line, we're actually growing. So even over here, we are still growing spending by 10 to 15% per year. And so that's actually very interesting. If this can lead EPS to hold up, and you pick companies that are going to grow earnings per share this year, you could, if this person's right, end the year in pretty solid position. Now, I still think we've got headwinds coming for semiconductors. I'm very excited to go deep on semiconductors and get a lot more exposure to the semis. But we are seeing chip prices trend down, especially if you track eBay chip prices and you track supplies for chips. Supplies for chips right now are blowing up. In fact, right here are inventories, total tech inventories up 8 days on the usual 5-year median. Upstream, downstream inventory, this has to do with subsidiaries. This is all up. Memory, storage, semiconductor inventory, OEM inventory, everything, with the exception of distribution inventory. Every kind of chip in the semiconductor sector is up in terms of how much inventory we have. So we're thinking that maybe in Q3, we're still gonna have like a semiconductor potential bottoming out. But maybe if we get a bottoming out now, between now and Q3, which Q3, folks, starts tomorrow. We start new prices on the courses on building your wealth as well tomorrow, but Q3 starts tomorrow. So we could see a potential bottoming here, which is hopeful. But then again, I don't really like to play hopium. I like to play reality, and I like to make the dollar hollers, okay? All right, let's now hop back on over.
Index for bankruptcies is at record lows. That's not what happens when you're going into recession. That's not what happens when the economy's melting down, that fewer and fewer people are going bankrupt. You would need to see that spike if you're going into recession. If you look at people who are defaulting or businesses defaulting on loans or not making loan payments, we're not seeing that at all. Anastasia was talking about a soft landing, but in many ways, this environment there's this. If you look at the stock market, you feel like it's a recession, and then you look at these metrics on the health of the credit market, and it just doesn't feel recessionary. So I don't think the Fed is going to obsess on the stock market and blink on that. They will blink if the consumer falls apart. That's a whole different issue. They care about the consumer. They care about jobs. They care about spending.
Okay, first of all, I'm sorry. I gotta buy a new HDMI cable. I don't know what the heck is wrong with that one, but clearly it's got a problem, okay? But folks, let's talk about the consumer then. What happened this morning, folks? We got the personal consumption expenditures ratio, which showed us our first decline in real spending since, folks, December. So people are spending less. The consumer is spending less. Again, we saw that in the credit card data. It's not just Barclays who's seeing that in their credit card data, but JP Morgan is reporting that they too are starting to see declines, and this is why they're actually writing down a substantial amount of equity valuations. In fact, and I'm still working through the report, but JP Morgan did this substantial deep dive into downgrades. Downgrades for a lot of their companies. I'm on the Trivago section. Let me jump to the front here. Look at this. Here you can see the overall macro environment has deteriorated since Q1 earnings, with inflation reaching a 40-year high in May, fuel costs up 45% since February, and Chase credit card data indicating slowing consumer spending and lower consumer confidence. They project a 66% chance of a recession in the next 2 years and an 83% chance of recession over the next 3 years. They believe that the internet sector continues to be more mature and therefore has less ability to offset broader market trends. Now, that's actually a lesson right there. If a company is less mature, you can kind of really still blow up your growth even in a recessionary time because there's so much demand potentially for your product. What does that make us think of? Tesla. It's still not a mature automaker. It's still young, right? But once you become mature, well, then you are subject to the whims of the macroeconomic cycle. This is why when we were looking at the earnings call for, not just the earnings call, but the actual earnings report for Nike, which every day in our course member live streams, we go through fundamental analysis, whether it's earnings calls, press releases, 10Ks, 10Qs, whatever. What do we see? We see a 5% decline in net income year over year at Nike. And not only do we see a decline of net income, but we also see a decline of revenues of 1% year over year. You know, this is a company that's subject to the whims of the macro cycle because it's more mature. And so I think this becomes very important when you're picking investments in this kind of market. Sure, could we have a great Q3 and Q4 as maybe finally we see inflation peak? Look, I want to be the cheerleader for that idea. Absolutely. And I'm going to tell you a little bit about what I'm doing right after I say, where is our inflation chart? We got to get inflation out. Yes, here. I wanted to show these. Right after we start actually seeing inflation go down, right? Which, here's a chart on the average price of gasoline. 16 days of drops in a row. This is good. We've seen oil move down, though there's still people shouting that oil's going to go to 150. I don't know if it's just fear-mongering. We've seen the 10-year treasury yield plummet. The 10-year treasury yield is right here. Look at that plummet that we got on the 10-year treasury yield. It's under 3% right now. People are, picking up bonds again. They might think the bottom's in for the bond market. Why? Because maybe the bottom's or the top is in for inflation. Because look at the break-even expectations for inflation. This is the 5-year and the 10-year. The white line is the 5-year. And look at it. The expectations are plummeting. Here, I'll remove myself for a second. There we go. Look at this. This is like straight down, folks. If I draw a line from the bottom, we're now at least on the white line, which is the 5-year break even. We're at the lowest point in inflation expectations for the market that we've been in since October of 2021, which is incredible. And the lowest level since January of 2022 for the 10-year curve. This is very interesting. The market seems optimistic, at least, about this idea that, yeah, inflation might be peaking here. And we are starting to see commodities rotate down, whether it's gas or oil or other commodities that have peaked, such as a big one, obviously, in the past here has been nickel or copper, right? And we've seen some peaks in some of these commodity prices. And so this is, again, leading to at least some hopium that, hey, maybe, just maybe, we could be starting to see a peak of inflation. Now, what do I personally think? I don't actually think we're going to see a real peak on inflation until probably somewhere around July to early September. And so I should clarify that. I don't think we're going to see a peak of inflation until either the July or August CPI report, which we'll get those between August and September, right? Because they come out the month later. But from there, I do think the way commodities are looking now, the way fuel and energy costs are looking, and the year-over-year comps that we start having to lap when we get to the Delta variant level of inflation, which really started picking up in September, we should start seeing drops when we get our CPI reads for September, October, November. I'm hopeful, but hopium doesn't work so well, right? Hopium isn't an investment strategy. So what is my strategy right now? Well, my personal strategy is no debt, take whatever real estate I can, buy the dip on painful red days in the stock market, keep some cash on the sidelines, whether that's 10%, 20%, something like that. But otherwise, I'm in. I'm buying this stuff. I'm not going to pass up on, in my opinion, the opportunity of a lifetime to build quantity of shares. And if that means Tesla goes to 400 or it goes to 900, it doesn't matter. Just give me the quantity, for example, on Tesla. If that means Nvidia goes to $100, I'm buying. Trade desk back under 35, please give me some more. Enphase 130, I'm ready to go. So I'll use that cash for some other opportunities. But otherwise, I'm in. And I'm excited. If you want to see every move I make, remember, Stocks and Psychology of Money. Folks, you get lifetime access. Thank you so much for watching the video, and we'll see you in the next one. Thanks. Good luck. Bye.